Hey guys, and welcome back to the Young Investors Podcast. This is episode 34, and joining me as always is Brandon. How's it going, Brandon?
Hey, I'm going well. I am pretty damn excited for this week's podcast, not gonna lie. Having a decent interest in the AFL and investing. This is kind of like the perfect podcast for me.
Yeah, it's not your average podcast this week. We have a very notable guest on today. We have 2012 Sydney Swans premiership player and 2012 All-Australian defender, but most notably known as the Director of Business Development at Six Park and the host of the Richards Report, Ted Richards. How are you today?
Hey Brandon, hey Hamish, thanks for having me.
Hey, woohoo! So excited. Thanks for coming on. Yeah, sorry, this is a very conversational podcast. We're super excited to have you on. So, thanks for coming on, and it should be really good to have a talk to you.
Well, I'm excited to be here too.
Yeah, we're super excited to have a chat to Ted today. We're basically going to go through a couple of different sections. We're not going to do indices or news today. We're actually just going to, first of all, talk just to Ted about kind of AFL and the Richards Report and his background in finance and that sort of stuff. We wanted to talk a little bit later on about behavioural finance and kind of emotions and stock market investing. And we've also got a few Q&A questions as well that you guys have submitted to us on Instagram that we are going to ask to Ted as well. So with that said, let's get started. So I'm curious actually, Ted, as to your background in finance, because obviously most people listening to the podcast would know you from the AFL. Is investing something that you were always interested in? Did you kind of do it while you were playing or even before you were playing footy?
Yeah, I was lucky enough to get drafted when I was 17. I had just finished year 12 and started my football career when I was 18 and studied part-time. I did a Bachelor of Commerce and went on to do a Masters of Applied Finance and was lucky enough to play football professionally for 16 years. So when I finished the Masters, I started to work in the industry, albeit just part-time. I worked under a fund manager and I thoroughly, I've got a big passion for football, but there was always this passion for investing too and making the most of the investments and I guess really being engaged and learning more about it. And I love it. I very quickly realised it's what I wanted to do after football. And that's where I am right now, and I'm involved in the industry, and I really enjoy it.
How commonplace is investing sort of in the football community? Is it something that a lot of people are thinking about during their football career, or is it really something that's sort of unique and something that a lot of people aren't thinking about?
Well, in the AFL world, it's probably so many players turn to property, and which is fair enough because property comes with the many benefits that it does. Whereas I quite enjoy the other aspects of property too, and other asset classes, be it Australian shares or international shares, and even other asset classes too, like what's going on with infrastructure and the opportunities there. And bonds aren't too exciting. They're not too sexy. They're pretty boring, but they can provide.
No one gets excited about bonds.
But they do serve an important role if people are going to set up a legitimately diversified portfolio. So, I think most of the conversations held in the change rooms with footballers is about property, and but every now and then something stupid or something different comes along, like Bitcoin, and I'm sure those conversations take place too.
I like how you said something stupid.
Something different.
No, we're on, I think we might be on the same page with that particular asset class. So taking it back, okay, so you started playing footy when you were quite young. Were you already, even when you were growing up and playing footy, were you always thinking about, investing is something that's really interesting? Is there anything that kind of sparked you to get interested in investing in finance, or is it something that was just always there?
No, it wasn't always there. It was, I guess, when I started to earn a little bit of money and trying to work out what I was going to do with it. And my dad gave me a book by Peter Lynch that some of your listeners may be aware of, called One Up on Wall Street. It's a bit of a classic. Right. And the book, very quickly, it's all about how people can outperform professionals. They can identify investing opportunities that analysts and professionals can't identify, and really kind of gives a bit of a roadmap as to how to go about this. And the book was written in the late 80s, and at a time when maybe there wasn't, the industry was certainly competitive, but it possibly not to the extent that it is right now. And I think the book in hindsight gave me this, I guess, a bit of overconfidence of how easy this is, that for an amateur to outperform professionals that have been doing this for decades. And so I lost a bit of money, and I called it an expensive lesson, the process that I went through. But I guess that was, to answer your question, I feel like that was the catalyst that really sparked the interest and the excitement of for me with the industry.
Yeah, sounds like that. That's kind of a similar way that I kind of got into it. I found some books and kind of got into it as well, into investing, and then, like you, started out when I started earning a little bit more money. Probably not as much as an AFL player, but a little bit more. And like what you're saying, I tended to make a lot of just classic beginners' mistakes, and tried to learn from that as much as possible, and then from there, just kind of learned from the greats like Warren Buffett and whatnot, and actually developed more of a structured way of approaching investing.
Well, my first investment was I started seeing bonds and undies everywhere, and probably going back to 2001, and so that was a bit of the philosophy of the book is identifying something that's changing. And so I looked into it and saw that Pacific Brands owned bonds at the time, and that was really the philosophy of why I wanted to invest. And what I didn't do enough due diligence and look into the fact that Pacific Brands owns so many other businesses apart from bonds. And even though my thinking was actually correct, that bonds was actually going well, Pacific Brands at the time owned so many other businesses that were going backwards that affected the share price so much more than what the bonds. So so it's I only lost a little bit of money, but still at the same time it was I was 17 at the time, and I think a lesson learnt there.
Yeah. It's funny how the stock market humbles you like that at the beginning, because
exactly.
when you start out and you start learning about it, you're right, you get that overconfidence that, this is real easy. And especially in some of those books, while they are useful for getting people interested in the stock market, they often simplify like the fundamental analysis of stocks in those books, and it makes you kind of feel like you could just do it very easily, and then of course for most people it's a painful mistake where you kind of get a reality check and you start to really realize that if you want to do this seriously, there's a lot more work that's involved in learning about fundamental analysis and how to actually consistently outperform the market.
Exactly.
One of the things I found interesting as well that I actually learned off of one of my friends that I never really thought about is with these kind of investing books and courses and whatever that make everything seem really easy. I never really thought about this, but the reason that they sell so well is because they make things seem easy. So
I totally agree. I can remember reading a great line the other day, and stories beat facts. A good narrative, it really elicits an emotion, and people they feel like, I can do this, even though the facts probably suggest how hard it is.
Yeah, exactly right. Yeah, I found that so interesting. It's like that's actually a sales tactic for these books to make it seem easier. So I wanted to talk as well, Ted, about the Richards Report, another podcast on that's Australian home and grown and talks about investing, and you have some quite notable guests on there as well. What was kind of your inspiration for starting your podcast, and how long have you been doing it for?
Yeah, probably like yourselves. I got a real passion for investing and really enjoy it, and I also listen to a lot of podcasts too, and I just found so many of the podcasts that I listen to about investing and the process were American, And I
Yeah.
thought, well, I thought, well, let's give a go of starting up a podcast and not be myself just talking about investing every episode, but rather try and get on an investment expert, and my job would be just to ask the right questions and to try and educate the audience, and with a bit of insight from people that have got far more experience in the industry than I. And I was a bit unsure how it might go, and I was a bit unsure how to put a podcast together first and foremost. But yeah, pleasingly, it's gone quite well. And unlike you guys, I only do one episode a month, but I've been going now for about 2.5 years. So I think we're up to about 30. When I say we, it's me. We're up to about 30 episodes.
Yeah.
And it's not. It's about investing, but as we learn more and more, investing is not just about the fundamentals. It is about how people behave with money. And so I really, from time to time, get into how we can improve just in decision making and different things that people are doing around the world in different industries to improve decision making, because that is, in a nutshell, what investing is. So I really enjoy it. I do one episode a month, and if listeners would like to check it out, it's called The Richards Report.
Awesome. And here's a question for you. Have you ever considered starting the Ted Richards YouTube channel?
No, I'm fascinated that you guys do, because I think it's another form of media that is great just to engage people. So I've got to look into it more, but I don't know YouTube that well, so I'll be hitting you guys up for advice.
I reckon you should. I was just looking at some athletes that have now turned into YouTubers as well. There's some pretty notable names. There's Nico Rosberg, retired Formula 1 driver, Kevin Durant, the basketballer, Stefano Tsitsipas, the tennis player. I tell you, even Charlie Dixon has a YouTube channel from Port Adelaide.
Oh, good on him.
Oh, wow.
Yeah. Although, to be fair, his is not about AFL or investing or anything in the slightest. He actually just talks about cars. Yeah. But look, I reckon there's a market there. I reckon you could slide right in, start a YouTube channel.
Yeah, I'll try it. Sometimes my mates tell me I've got a great face for podcasting, so I'll have to...
Oh, that's rough.
Yeah.
Now, talking more about the Richards Report as well, I've noticed that you've had some discussions with, say, like Chris Judd and Jobe Watson on the podcast. Are there a fair few AFL players that you've kind of connected with that do like to focus on investing, or is it a bit of a rarity?
Yeah, it's those. I actually grew up with those two guys. They're been mates for a long time, and I wanted to speak with those two because they're quite fascinating for what they're doing after football. But they're both very different with their investment philosophies. Chris really likes investing in shares and equities, but probably quite different to most. He gets right into the small caps, into the micro cap stocks, and Chris is very disciplined and puts a lot of time into it, so much so that I think Monday to Thursday he's pretty much all about managing his investments in this space, and whereas Jobe is a bit different. Jobe's got quite a successful property business, and he's also involved with a couple of businesses over in the States, in particular a cafe chain and some gyms. So it's I've spoken with those two guys from the football world. Andrew Welsh has made, he's a former Essendon footballer, a lot of money in the property market in Victoria, and so much so that he's now in the well, it's not BRW anymore. I think it's now the AFR Young Rich List. And, yeah, and
wow.
So I think they've got some really interesting stories. But the next person I'd like to speak, I'm intending on speaking with from the industry, is Andrew Pridham, who's currently chairman of the Sydney Swans, and I want to speak with him because Andrew's set up an investment bank in Australia called Moelis. And he's grown it so big that it's now a publicly listed company. And at the same time of doing all that, he's also a chairman of a football club, which is almost a full-time job in itself, and how he goes about that. So I think
it's crazy.
Yeah, when it comes to football, so many people think that football and investing are two totally different industries, but the reality is they're both so competitive, and there's the obvious big differences, but it is, you can draw life skills from one and apply it to the other, and more often than not, it's all about discipline, because it doesn't matter whether you played a good football game last week or last month or whatever, the process starts again. And so when it comes to investing, you might have got a stock call right, or you might have made a purchase that's gone quite well, but unless you can back it up again, I guess you're not going to outperform the market.
Yeah, and one thing that I guess is on the opposite end of the spectrum there is that I feel like it's fairly commonly observable in the world of professional sport that kind of these, especially very young sports stars, they end up being in quite a bit of financial difficulty later in life, mainly due to kind of lack of career longevity, and also kind of like those short bursts of very high income that just cause that lifestyle creep. Is this something that, from your experience going through the AFL, did you kind of see this in some people around you? Or, is this kind of an overblown issue that actually doesn't really happen too much? I'd be interested to hear what you think.
Yeah, I was on the board of the AFL Players Association for quite a few years, and the reality is that you give young players, young people a bit of money, they're not always going to make smart decisions. So we had things in place to try and ensure that people could, have some smoothing with their income over the course of their career. But most AFL players have managers that really support them with this. But
right.
I'm aware that there's some horrible stats in the US with in particular with footballers in the NFL and basketballers in the NBA that really make a lot of money in a very short period of time.
Yeah,
they get that lifestyle creep. Their professional sporting career finishes, but what endures is the lifestyle and that spending behaviour.
Yeah.
And 3, 4, 5 years out of retiring, instead of being set up for life, they're actually, some even become bankrupt, quite a high proportion. So we don't experience in Australia to the extent of what's going on there. But I also keep an eye on people outside of that, because I think I saw the other day that Rihanna once sued her financial advisor for some dodgy advice that she was received and lost a lot of money. And I can even remember reading about Drew Brees, which some of your listeners might be aware of, one of the most successful quarterbacks of all time. I think he's currently playing with the Saints right now in New Orleans. And he sued his financial advisor for buying something like $9 million worth of diamonds that turned out to be fake. So, there is some terrible decisions that people make, and that's why it's just so important about really getting the right advice and I guess not making stupid decisions.
Yeah, I guess another thing is that when you come into so much money early in your life, you have a lot of people coming to you with investment opportunities, I guess, and trying to tell you what to do with your money. And that can be really difficult as a young person to sort out what they should really be doing with their money. During your football career, what were some of the strategies that you employed to make that transition?
Yeah, I guess so much of people will look at investing as to the way to make money. And to a certain extent, that may be true, but the best thing you can do to make money is to improve your savings rate and to improve your increase your savings percentage. So basic personal finance, things like paying yourself first. You don't have to get too granular with a budget, but really trying to identifying want versus need and delaying gratification. for myself, the mistakes that I could see that footballers were making was on some of the big ticket items when it came to things like fancy cars, which is from an investment point of view, it is just a terrible.
It's so bad.
Oh, it is so bad, and it really does promote that lifestyle creep, and so I'm very proud to say that in my last year of football, after playing football professionally for 16 years, I was driving a 1995 Toyota Corolla.
Yes.
Yeah, and which really stood out like a sore thumb in the player car park. But I was like, I live 2Ks from the club. I really, I see no point in dropping a lot of money just for a 5 or 10 minute commute each way. So yeah, I'm getting quite specific there, but to answer your question, when it comes to setting yourself up, be it in football or something else, investing can be a part of it, but the ability to increase your savings rate is also fantastic.
Personally, I think that a Toyota Corolla is a millionaire's car.
Yeah,
that's the way I like to look at it.
Yeah.
I think Warren Buffett, he drives some sort of like really old Cadillac or something like that, like some beat up old Cadillac. So when people think of millionaire cars and they think of Lamborghinis and whatnot, I think of the Toyotas. So you kind of finished your AFL career, and then after AFL, you've kind of joined up in the business called Six Park. I was interested in kind of how you got started with them and kind of what does Six Park do? Yeah, how did you kind of just get involved with that?
Yeah, so I was working under a fund manager, Early Funds Management, whilst I was playing, and I had a friend in Singapore that suggested I catch up with someone for a coffee that was setting up a new fund in Australia called Six Park, and so I sat down one of the co-founders of the business, and he was telling me about the benefits of technology and what it now can provide people that need professional investment advice, but just can't afford what it typically requires to see someone face to face. And the more I looked into it, and the more it made sense, because I've seen so many people, inside the football club make silly decisions, and I could see what is called robo-advice just growing in popularity around the world, in particular in the US and the UK. And this gentleman, Pat Garrett, who's one of the co-founders of Six Park, asked if I'd like to be involved, and I was just so excited to take on the role, because I think it's at a time of such low trust in the industry, with what we've seen through the Royal Commission, with people overpaying for underperformance and all these conflicts. I think it's refreshing that there are some opportunities out there where people can have a low cost professional advice, and it's fully transparent, and everything that so many things aren't.
So the term kind of like robo investing, what kind of is that for listeners that don't know, and what does kind of Six Park offer in that space? Yeah,
well, first thing I want to say, it's not a great term, robo investing. I'm not sure who came up with it. It makes people think that it's something that it's not. All it is investment management, but online. So you could call it digital investment advice, but it's by no means is it just robots. Like, well, there is a real real humans working behind this. We've actually got a fantastic team of people that have been chairman of JP Morgan, co-CIO of the World Bank, Lindsay Tanner, the former Minister of Finance for the Australian government. All these people are involved in the business, so it's by no means just robots roaming around. And all we do is we get clients invested in their own globally diversified portfolio according to their risk profile. And I know that there's a lot of buzzwords there, but some people are happy to take on a bit more risk, and we can provide them with a bit more exposure to shares, whereas some people are a bit more conservative, and you provide them with a bit more exposure to defensive asset classes like infrastructure and bonds and property. And there's real people that look over your portfolios, like the investment committee that I mentioned before. And since inception, which is about 3 years ago now, our growth portfolio's returned just over 35%. So,
Oh wow.
yeah, so it's providing people that would like advice and need a bit of help, a model where they can get that. But so, for example, if $10,000 is our minimum investment, and for everything that I mentioned before, clients pay just 0.5%. So on $10,000, that's $50 a year for everything. So it's really changing a model where, addressing a need for they call it the advice gap, the people that can't afford to pay the thousands of dollars to see like a financial advisor or something similar.
Okay. So in terms of price, there's a substantial difference between having a traditional financial advisor and using sort of a robo-investing on online investing platform. Is there any other major differences that you've noticed, or major sort of benefits, I guess, from having robo-investing rather than having an actual financial advisor?
Yeah, and there are benefits to having an actual financial advisor. So they'll typically catch up with you face to face, which I'll be upfront. We don't usually do that. We normally engage online. But the other thing is we provide investment management. So we'll look after your investments with Six Park, as opposed to, we won't provide you tax advice. We won't provide you estate planning or superannuation. I'll be fully upfront. We just related to your investments with Six Park.
Okay, cool. And so I guess just to transition from Six Park now, in terms of you personally, how do you go about your investing? Do you invest in individual stocks yourself, or how does that look?
Yeah, so I've got the majority of my money invested with Six Park, which and the investment philosophy at Six Park is really evidence-based investing, and what I mean by that is the statistics say through the SPIVA report, which is the S&P Index versus Active report, that most professional fund managers actually underperform their benchmark once you take into account their fees. So our investment philosophy is all about keeping your fees as low as they can, because it's one of the few things you can control, and getting your returns on diversification and asset allocation rather than trying to pick one stock over another. So there are many people out there that will try and pick one bank over another, be it Westpac over ANZ or a supermarket over another, like Woolworths over Wesfarmers or whatever. But we think that is incredibly hard to do time and time again. So we were quite what they call passive, in that we'll use ETFs to get exposure to each asset class, and we just select and identify the best ETF that we think is that fits the requirements to get exposure to each asset class. And we usually look at ETFs for three reasons. So one of which is the index that it tracks. So when it comes to the Australian market, we invest in the ASX 200, the 200 biggest companies in Australia. The fee level, which is also referred to as the MER, and we try and keep that as low as it can. And this is possibly the most important, is the liquidity of it, and how liquid it is in terms of the amount of buyers and sellers, and the liquidity of the underlying holdings within the ETF. And so because it's invested in the ASX 200, they're very liquid companies. ETFs can be a bit illiquid once you start investing in companies that aren't traded too much.
All right, so we'll just let that lead us into the next section we wanted to talk about, which is behavioural finance. So this is a topic that I studied very briefly at university, but I don't know a whole lot about. And Brandon, how much about behavioural finance do you know?
I know roughly what it is, but I've never studied finance in my life.
Okay, so there's two very uninformed people here about behavioural finance, but we also have Ted here, which is who's going to sort of explain some concepts about behavioural finance a little bit further in depth. And essentially, I'll just sort of start with what behavioral finance is. So from my understanding, it's essentially the study of sort of the psychological side of the stock market. And how would you describe behavioral finance, Ted? How would what's the best way to describe it?
Yeah, I guess there's the classical economics assumes that people are always rational and will always make decisions that are in their best interests, whereas the study of behavioural economics, I guess, is open to the fact that people aren't always rational. Sometimes people make decisions that aren't in their best interests, and it's the reality is I'm far more of the believer of the latter than the former. That people aren't always rational. Quite often, people can be their own worst enemy, and so I could see this as being so important. So I went over to Harvard Business School last year and did a course on behavioural economics, because I can speak, or we can speak, the three of us right now, about all these logical and rational things about diversification, keeping fees low, and asset allocation. We could talk about that for hours. But the reality is, if someone at the end of this podcast chucks on the news and sees some headline about, I don't know, some person making some quote about a crash, be it in the property market or the share market, or someone just sees something, it can totally change their behaviour from being very rational and composed to really making some poor investment decisions. And that's what we see when the market comes back. Buffett's got that analogy that it's the only time when people run out of a store when things are on sale. And it's so true. People really draw comfort from investing in a rising market, but with the reality that assets are becoming more expensive, and so there are so many behavioural mistakes investors can make, and there's so many biases, which I'm sure we'll get to shortly, that we're all prone to. So it doesn't affect just one or two people. We're all prone to making these mistakes.
So one thing I found interesting about kind of listening to Buffett in all the stuff that he puts out there is that when the most basic of basic stock market principles of buy low and sell high are very, very frequently done in reverse, where people buy high and sell low. And to me, it's just like, it doesn't, you just look at that and you're like, why? Like, how? But it's so true. It's the one thing I found remarkable, especially like doing YouTube and looking at comments and popular comments and comments that come up a lot, is just how much people's emotions can really get to them when they're investing. And just, to me, I found it absolutely remarkable at how sometimes the most rational of things can just go completely by someone that's looking to invest, and they just start investing purely on emotion. And it's interesting how much emotion can sometimes drive the market. And when I heard I can't remember where I learnt this, that basically the stock market boils down to fear or greed. And I was just like, actually, this makes a whole lot of sense. And it makes sense as to why people are always buying high and selling low, because it's not about being rational. Most of these people are just being affected by emotions and just making fast decisions based on what they're feeling. I found that quite remarkable when I was kind of learning about investing.
Yeah, I found the exact same thing in my YouTube comments. The amount of people who will leave a comment saying, can you explain to me what happened to this stock on this day? And it's just like, I don't know why it went down 0.4%. There's no way that you can, people just getting so attached to the short-term movements of the stock market and so worried about what's happening with their stock on a day-to-day basis. And you can just see, and it's something, it just shows, this is something that really bothered me when I was learning about efficient market hypothesis at university, was that one of the key parts of the model is that, as you said, people always act rationally. They always make rational decisions based on the publicly available information, or publicly and privately available information. And I just thought that was absurd, because I don't think that it's possible that people could always be acting rationally when making investment decisions.
Yeah, there's a great line that I love, and that is, when emotion is high, logic is low, and which I think is fantastic. But there's two examples about how we can be irrational when it comes to not just investing but money, and one of which we have seen is the volatility with Bitcoin, where I guess that fear of missing out and was just so prevalent about 12 months ago. But the one story that I want to touch on is here is a way that we can be affected by outside noise. But when a neighbour, and this has been proven, when a neighbour of yours wins the lottery, the chances of you going bankrupt significantly increase. And and this has been proven. And the reason why this is because all of a sudden someone's spending patterns and what they're buying influences your spending patterns and what you buy, because you're trying to keep up with them. So all of a sudden you start trying to take on more risk to keep up with them, and the chances of you going bankrupt, and it's a fantastic study that so I encourage people to look that up and have a read. And I think that just describes about how these outside noises and influences can affect our decision making.
Yeah, that's really fascinating, because that's something that, I mean, I just wouldn't expect that to be true, but the fact that that's something that we've seen is just...
That's classic keeping up with the Joneses.
Exactly.
Yeah. It just shows how deep these biases can really go, and how unconsciously affected by them you can be without even knowing. Some of the more notable ones, I guess, would be sort of like confirmation bias, one where you're sort of seeking out information that confirms your original hypothesis, so your original belief in something, and just chasing after articles that confirm your bias, and ignoring or giving less weight to articles that sort of go against your bias.
Yeah, I totally agree. So there are some other ones out there that with recency bias, where people, I guess, will, and to be fair, I can understand it, but they'll put more emphasis on things that have happened more recently as opposed to things that may have happened in the distant past. And the other one that Australians can be so prone to is the home country bias, where Australia it takes up just such a small percentage of investable opportunities around the world, yet so many of Australians just keep investing in Australia. And the franking credits have been front and centre in the news right now, but I think that many investors really kind of put the franking credit benefit far before any benefit as to the benefits that diversification can bring to their investments.
Yeah, and that's an interesting thing, actually. You bring up the home ground bias, is that when I started looking at, when I first started investing, I started looking at Australian businesses. Well, one of the big things that I now focus on is staying within my own circle of competence. So if I'm looking at a business, look at something that I use, or that I have good experience with, or that I could reasonably understand. And looking at a lot of these Aussie companies, just sticking to Australia because, sure, Australia, I like Australia and it's where I come from. I'll probably understand it better. And I see like these banks and these resource companies. I'm like, damn, I don't know anything about like these kind of companies. And then it took me a while, but I kind of realized, hang on, why am I just limiting myself to just looking at what I don't understand in Australia? So I started like opening up my mind a little bit more, looking at American business. I was like, actually, you know what? my own life is probably influenced more by American businesses, like whatever it might be. I don't know, Adobe or Facebook or any of these kind of big, or Amazon or something, these big American businesses. I was like, okay, maybe I should actually stick with what the best investors of the world say and stick within your own circle of competence. And I shouldn't be so kind of like tunnel vision just to looking at Australian businesses. So I can understand that one, definitely.
Yeah, it's a fantastic awareness of yours. Howard Marks talks about the circle of competence, and I love how what he says is it's not about how big your circle of competence is, but a real awareness of where the where the boundary lies, what is inside and what's outside. So,
Yeah.
so good on you for being able to acknowledge that.
So when we talk about these kind of I don't know, points about behavioural finance and how people kind of get themselves stuck going backwards by kind of buying high and selling low, and just their emotions get way too caught up. From your experience, Ted, I was wondering, what are some of the strategies or just investment vehicles that just everyday people could use or look at just to get their emotions out of their investing habits?
Yeah, I guess the study of behavioural economics is all about removing and improving your decision making. Is removing the chances for our gut instincts and intuition to kind of get in the way when these noises affect us to change the strategy. So it's I guess there's probably a couple of things you want to tick off. Is what is evidence based, and that is that the most professionals underperform the market. So to really look at the benefits of investing through exchange traded funds and keeping your fees low. And rules-based approaches to investing. So, and what I mean by rules-based is the fact that, remove that inability, the noise that comes into us and affects our judgment. So, I know that surgeons use checklists before they to go into surgery to improve their chances of success. I know pilots have similar checklists, and I think that's a fantastic thing for investors to have as well, is to say, well, when it comes to rebalancing, you will be affected by and want to keep investing in the things that are going so well, and it's going to be hard to buy things that have underperformed. But the reality is that can quite often be a fantastic way to rebalance your portfolio. So. I guess there are two things that you can to improve your decision making when it comes to investing.
Yeah, so would you say that for most people, staying away from active investing would probably be the best option, and just to try and passively invest and diversify across different asset classes and different countries and that sort of thing?
Well, I'm obviously biased in that's our investment philosophy, but I'm not so biased to think that you can't have a core and satellite approach where you may have the core managed that way, and like you mentioned before with your circle of competence, and where maybe have some active positions in companies that are well and truly within your circle of competence, and you actually believe that something more than most people don't, especially more than someone that's on the other side of the trade. So, but I'd be very hesitant to think that most amateur investors have the ability to spread themselves very wide and invest across multiple industries, multiple countries, and think that they can outperform people on the other side of the trade.
Yeah, I think I'd probably agree with that.
Yeah, I'd agree. I think that's the one thing, like I really like the idea of active investing and looking at individual businesses and making sure you're in your circle of competence and demanding margin of safety and all those good kind of principles that we talk about. But at the end of the day, from my experience, I still think the vast majority of people, especially people that don't have the time or the energy to put effort into looking at individual businesses and analyzing them through a value investing approach, it's just so I suppose not easy, but it's quite simple if you follow those rules of wide diversification, not trying to beat the market a lot of people can't, but just try and participate in the market, use things like, I don't know, robo-advisory service or ETFs and that sort of thing, and just take your emotions away. And I remember I can't remember where I saw this, but they said that the passive investor has one superpower, and their superpower that makes them win is the fact that they don't care. I think that's just so smart. It's just the fact that the passive investor more than likely will come out on top by the fact that they just take their emotions and just leave them at the front door. That's it's a bit eye-opening. So I probably agree, for the vast majority of people, it's probably the passive investing approach that's going to be better suited for their long-term kind of financial success.
Yeah. What with passive investing, you're never going to be the best, because there'll always be a company that you're going to miss out on. But so that's the negative. But the benefit is you're never going to be the worst because you are getting average returns. And I think the benefits for never being the worst far outweigh the risks that it takes if you're always trying to be the best. If you look at a company that goes back, a stock that goes back 80%, which can happen from time to time in certain industries, but in certain sectors. But the reality is you don't need that company to go back another 80% to be back up to where you are. You now need that company to go up 400% to get your And so it's more on the passive side. It's probably a bit more possibly the smaller wins that you might get as opposed to chasing some of these big returns that you might be able to get if your calls come off. But there's a great line by Bill Gates that I love, and that is people overestimate what they can do in 1 year, and they underestimate what they can do in 10 years. So if if you've got a bit more of a long-term outlook, you can really over time get the power of compound returns really working in your favour.
Yeah, and having a loss of, I saw something interesting. I can't remember the exact numbers, but there was 2 portfolios. One earned a pretty moderate return every single year, pretty consistently for 20 years. And then another portfolio earned a very consistent return, but slightly higher. But then in the 20th year, there was a 30% loss. And that portfolio that every single year up until the 20th year had a higher return, but because of that 30% loss in the last year, they actually underperformed the more consistent and lower return. And I thought that was quite interesting, and that kind of plays into the passive versus active investing, because if you're passively investing, you're always going to be getting that average market return consistently over time, whereas that active investor, it could just be 1 or 2 bad investments where you have a significant amount of your wealth in that investment. If it goes wrong, it can significantly set you back compared to someone who's just passively invested over their lifetime.
Yeah, incredible. Yeah, exactly right.
So basically, if you're just here for talk about AFL, the analogy is if you're marking up Buddy Franklin, you don't try and take a hanger, you just go the spoil. Okay? Just go the spoil.
Go and play on someone else. Don't play on Buddy.
Go play on someone else. Fair enough. I think that wraps up quite well about kind of our discussion on behavioural finance. I think we're all in the court that behavioural finance kind of wins the day over something like efficient market hypothesis, and I think we're all on the same court that ETFs are the way to do it, especially for the vast majority of people who don't want to sink that much time and effort into individual businesses. So I think we'll leave it there. And the last section that we wanted to go through is we wanted to give obviously you guys a chance to ask questions to Ted. So we asked you on Instagram, and we've got a fair few questions to get through today, so we'll see how we go. Some of them are quite funny. I like these questions. But our first one from one of our viewers is, what are some of the common investing mistakes that you see from people that are just starting out with investing? Have you made any mistakes that you have learnt from in your own investing?
Yeah, there's a bias called the Dunning-Kruger bias, which that's all about where people overestimate their ability to be good at something, and
right.
To be fully upfront, I see myself in this, and how my investment that I made, in my late teens and early 20s, in trying to think that I can beat professionals. So I think that Dunning-Kruger bias, it's probably similar to that. It's just the overconfidence. So, for example, it's not uncommon for footballers to go into the hospitality industry and the restaurant industry with no experience whatsoever in that, and to think that they all of a sudden. There's different things and examples that I've seen over the course of my career, but they're two that stick out.
Right. Okay. Another question we've got is, this person would be interested to know how much AFL players earn, and also, do players have to consult their clubs before signing deals with sponsors or companies, or is it just like, go for it?
Yeah, so AFL players are very well paid. I think the average wage now is above $350,000 a year.
Wow.
Yeah,
really?
Wow. Very well paid.
That's amazing.
more often than not, you don't need to consult a club if you're lucky enough to be able to get a third-party endorsement. More often than not, there's only a handful of players that really get those third-party endorsements at each football club. Most teams may have some protected sponsors, so the last thing those sponsors will be, if is wanting the players, competing with it. So there can be a couple of things, but for most players, they are very well paid. The negative of AFL is that it is such a competitive industry. I think the industry average is now about careers for about 5.5 years. So
wow, okay,
yeah. So it's a high churn. You if you don't make an immediate impact, they don't give you too many chances. You're out of the industry. So there's both positives and negatives.
Yeah, that's interesting as well, because just from my own personal experience, way back when I was like 17 or something, just going through, I was lucky enough to get through some of the Giants Academy kind of squads, and I remember we had this fairly sobering kind of talk by someone from the AFL that was talking at that stage. I think their average career lifespan for any AFL player was about 3 years, so it sounds like it might have even increased since then. So but yeah, it's interesting when you kind of look at it might be perhaps a high income or high salary sport. When you take into account the longevity of the career, or the estimated career span, it's actually not the best kind of equation in the end.
Yeah, I think that politics probably provides more job security than AFL football, and I was very lucky to play professionally for 16 years, but I think most of the contracts I had over those 16 years were 1-year deals. So yeah, not too much great security in those, but but I will be fair. We are well paid.
Yeah. No, I find that very interesting, actually. Moving on into the next question as well. Here's a good one. Who's had the greatest investment influence on you, and why?
Yeah, I'd say this would be probably John Sevior, who was a fund manager that I worked under for 4 years. I actually spoke with him in a podcast episode, and John is incredibly successful when it comes to it. He's got Airlie Funds Management, an Australian fund, and he is just so disciplined and so humble. And also he's been, without probably stating obvious, creating such a successful fund, very well off. But he drives a Golf. He doesn't let all the outside noise and all these things affect his decision making. And I just think having an investment philosophy where he's happy to miss out on some things. He knows he knows that of his investment philosophy, and he's so humble that he'll admit when he makes mistakes from time to time. And I just learnt so much off John in the 4 years I had working under him.
Okay, and sort of following on from that, we had another question here, which was, what kind of books or resources did you find particularly useful when you were learning to invest?
Yeah, I think I've probably already mentioned Howard Marks already, but he's got a fantastic book, The Most Important Thing, and it is so interesting about if listeners haven't read it, I highly recommend it, and you'll find yourself highlighting things time and time again. And to be fair, Howard Marks is an active fund manager that has had a lot of success, but his investment philosophy is all about, first and foremost, avoiding the losers, avoiding the potential losers, and letting the winners look after themselves. So there's many other books that I could go on, but one resource that I want to kind of share with listeners is, which I find social media gets a bad rap, and to be fair, for many reasons it should, but I find Twitter has been fantastic for me in getting in touch with some bloggers in the I think they call themselves the FinTwit community, like Morgan Housel and Ben Carlson. So I highly recommend if listeners are on Twitter to check out those two, because you get some fantastic free resources where you don't always have to commit up to a 300, 400, 500 page book, but it's just their thoughts on the market. Well, not so much, but their thoughts on
the kind of analysis. And
so along with that, but also credit to you guys and many other people in the podcast community, is some fantastic podcasts out there that provide free education resources to increase your education and insight. And the one I love is Barry Ritholtz's Masters in Business, which it's an American one. He's been going around a long time. It probably may get a bit deep for some people, but he's just fantastic, and I recommend people check out that.
Yeah, really good. We'll make sure we leave the links and that sort of stuff to the resources in the description and stuff. So yeah, that's awesome. It's a lot to us to look at. So that's awesome. The last question. This is a great question. I love this one. Who in the 2012 Swans team do you now think has the largest share portfolio?
Okay. Well, Goodsey won multiple Brownlow medals, and with that comes some significant endorsements, and I'm sure Goodsey would have. I'm sure he would have been well invested in the market. So I'm hopeful. I think it'd probably be Goodsey. If not Goodsey, Josh Kennedy has had a fantastic. It's probably got more to do with who's made the most amount of money out of playing football rather than when it comes to the investment philosophies. But I'm sure Joey Kennedy is doing quite well after being a champion of the game for so long. And
true.
Buddy Franklin wasn't part of that 2012 team, so
true.
He's not a part of the conversation, even though I'm probably stating the obvious there that Buddy would be going all right.
He'd be doing all right.
But I played down back in defence, so I think when it comes to the big contracts, look to the midfielders and the forwards, not so much the backmen.
Defenders, who needs them, right? No, that's interesting. Yeah, true. I was actually looking because this is 2012 was the premiership year, wasn't it?
Yep.
Yeah, and I thought that you would. You were a 2 times premiership player, but you got traded to Sydney the year after they won the premiership. Is that right?
Yeah, so Swans won in 2005. My first year at the Swan, I had 5 years at Essendon and came across to the Swans in 2006. We lost that year. That's right. Won in 2012.
That's a bad time to come across.
Oh no, it was fantastic to go from being what was then a pretty mediocre team to a team that went the whole way in the finals. But
that's very true, actually.
Yeah, I also played in the 2014 grand final and lost that. And when I reflect on winning and losing grand finals and kind of the learnings of behavioural finance, what some of your listeners may be aware of is something we get spoken about from time to time, and that is loss aversion, and that is the power of losses are so much more powerful than the power or the effects that you feel when you gain something. And when it comes to grand finals, it is so true that the emotions you feel when you lose a grand final are so much more powerful than the elation that you experience when you win something. Yeah. So that's relevant for football, but it's certainly relevant to investing and why some people will be so apprehensive about investing in something that has recently, lost, because people will be so worried about losing anything.
All right, and the last question we've got here is just that. What was the best investment that you've ever made?
Oh, best investment I've ever made. I could.
Oh, there've been so many.
No. I'm so good. No, well, I could talk about I could talk about my family and I could talk about my education, but I think I'm going to give.
People don't like.
I know, but I think what I'm going to say here is a bit boring, and that is
All right.
Is reading. There's
Yeah.
one of my favourite books. It is not an investing book at all. It's opened by Andre Agassi. I'm not sure if you guys have read that, but in the book,
No.
Agassi talks at one stage. He talks about how he was late to come into reading, and one of the things that he's going to be so big on these kids is to get into reading early, because it really has changed. Some of the books that I've read has really changed, both improved my football career and the relationships I have out, with friends and family, but also when it comes to investing, it really done that too. So I've got a book called Good to Great by Jim Collins that some of your listeners may be aware of, and I think that probably cost me $30 or $40 or something like that, and I think it was one of the best investments I ever made.
Fantastic.
No, that's good.
I guess it's probably as good a time as ever to wrap up this week's podcast. A very special thanks to Ted for coming on this week. It was great to have a chat with you for this episode.
Thanks for having me, guys.
Yeah, thanks very much. It was awesome. Really good to sit down and have a chat. I think that there's a lot of value in what you're talking about throughout the podcast. So yeah, thanks very much.
No worries, guys, and well done for what you're doing. I think it takes more time and energy than people think to get the podcast together, and so well done.
Thanks very much. Yeah, and make sure to check out Ted's podcast as well, The Riches Report, another obviously Australian homegrown podcast about investing. So go check it out as well. And once again, thank you very much, Ted, for coming on. Thank you guys very much for listening. Of course, we'll be back next week. So if you have any Q&A questions, of course, leave them in the YouTube comments section of this podcast, which will be on Hamish's channel. Gosh, that gets me confused sometimes. But thanks guys very much for listening. We hope you got a ton of value out of this one. And thanks, Ted, for coming on. And we'll see you guys in the next episode.